Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Moomoo. I will put a link to them in the description below. We will discuss their promotion more in detail in a little bit. Now, today I want to talk about how to quickly predict what the share price of a stock might be after an earnings release, as well as how to protect your profits. Earnings season has begun, and with it, a high concentration of potential investment opportunities. If you want to take advantage of a potential special opportunity in 2024, you can think about using Mumu, a one-stop investment platform powered by data and pro-level tools. Here we are on Mumu's desktop app. Right now we are on the earnings calendar. Now I use Mumu to predict the volatility of a company's stock price after earnings. This helps me develop a strategy to help me decide whether I should sell my shares before earnings or how I can protect my shares when I'm concerned about a drop in the stock price. Now, I'd like to first thank today's sponsor, Moomoo. Right now, new users are greeted with a generous welcome bonus upon signing up, adding an exciting boost to their trading experience right from the start. Right now, you have the opportunity to choose between two amazing rewards. From now until May 28, you can get a transfer in bonus where you can get a 1.5% cash reward on your initial transfer amount up to $300, or a deposit bonus where you can deposit $100 to receive 10 free fractional shares in top stock bundle up to $50. So go ahead and check out Moomoo. I'll put a link to them in the description below. Now, investors try to predict a company's stock price after an earnings report to make better trading decisions on whether to buy or sell. Earnings season can cause significant fluctuations in a company's stock price. But how much will a stock move after its earnings report? With Mumu, I can potentially predict the share price movement after the earnings report is released. By using the option chain, I can grasp the possibility of the share price volatility after the earnings report. And so we're going to be using Mumu's platform to learn how we can do this here today. Now, users can utilize the expected move method to forecast earnings here on Mumu. Simply select the first at the money straddle that expires after the earnings date and multiply the price of that straddle by 85% to get an estimate of the move. Keep in mind, it's worth mentioning that Mumu's earnings calendar is a useful resource. You can easily search for the earnings release date of any company and stay up to date with the earnings release schedule. With Mumu's earnings calendar, you can stay informed and make more informed investment decisions. So let's take a look at an example here. Let's say we wanted to predict what the expected move after earnings was for Apple stock. So here we are on the options chain. Notice on the left, we are on this options tab here, and we are currently looking at Apple. We're looking at the current options for Apple here. So the first thing we want to do is we want to make sure we go over to the straddle here. So if we click here, we can find the straddle and click it here. And then we also want to make sure we are on the correct expiration date. Again, we want to select the first expiration date that comes after the earnings date. Earnings for Apple is on May 2nd, so the first date after that would be May 3rd here. Now we want to select the at the money straddle and see how much that costs. Remember, the at the money straddle is going to be the straddle whose strike price is as close to the current share price as possible. Current share price of Apple is 173.50. The closest strike to that is going to be the one at the 172.50. So this would be the at the money straddle here. And again, we want to see how much the at the money straddle costs. So if we select this, the at the money straddle right now is going to cost about $7.19. Now we want to multiply that price by 85% to get an estimate of the move. So if we multiply that by 0.85, we will get 6.11. In other words, investors are expecting Apple's share price to move up or down $6.11 for earnings. Now, if we take 611 and divide by the current share price of Apple, we get about 3.5%. So in other words, investors are expecting Apple's share price to move up or down 3.5%. That is how we calculate the earnings expected move here on Moomoo. Now, it is worth noting that the market is constantly changing, so it may not necessarily rise or fall exactly that same amount as expected in the future. It's also worth noting that Moomoo's option chain offers a T-quote setup and provides real-time quotes free of charge and without any delays. Now that we understand the concept of volatility, let's say you have a positive long-term outlook on a specific stock, but you are concerned about short-term retracements. You might turn to a long protective put strategy, which can potentially help traders limit their potential losses should a significant downturn occur. So let's take a look at an example with Tesla now. So I'm going to go back up here and I'm going to clear Apple and I'm going to search for Tesla. So remember, the ticker symbol for Tesla is TSLA. There's Tesla. So I'm going to go ahead and press enter there. Now, a protective put position is created by buying the stock and then buying a put option on a share for share basis. This strategy limits the downside risk potential of the underlying stock, but it does come at a cost, however, as buying put options can get expensive. Now, the great thing about Mumu is that you can easily choose a stock secured strategy on this platform. So let's take a look at how we would set up a protective put here on Mumu. Again, using Tesla as an example. So now that we are on the stock that we want here, we want to go again to this place right here, click on it, and we want to click on covered stock here. And then we want to go ahead and filter by puts since we're focusing on protective puts right now. And so let's say, for example, we wanted the protective put at the 182.50 strike price. So we can go ahead and click on here to create an order, and we can see what we're doing here. Again, we would be buying the underlying stock, 100 shares of Tesla here, and at the same time, we would be buying a put on Tesla to protect this here. And the great thing about Mumu here as well is we can switch over to this chart view and we can see all of the important information that we need to see, like the break-even points, our max profit, our max loss, our probability of profit, and our probability of loss, as well as we can look at this chart and see what our profit or losses might be depending on the share price here. Now I want to quickly share the options pricing for Mumu here. So if we scroll down here, for equity options like stocks and ETFs, there are 0 commission fees. 0 platform fees, and 0 contract fees. Now for index options, Mumu also offers 0 commission fees, 0 platform fees, and only charges a 50-cent per contract fees, you can see here. So this makes Mumu one of the most competitive option investment platforms that I have ever seen. So remember, right now, new users can get 10 free fractional shares in the US market, which is worth up to $50 by opening an account and making a deposit by using my link in the description below. Remember, you can also enjoy a 5.1% APY on your uninvested cash and switch your positions to Moomoo now, and you can potentially earn up to 1.5%. So go ahead and check out Moomoo. I'll put a link to them in the description below. So today we talked about how to quickly predict what the share price of a stock might be after an earnings release, as well as how to protect your profits after an earnings release. So make sure you like this video. Let me know what you would think in the comment section below. Thank you for watching and have a great day.